Welcome to my channel. Today I want to talk about money, taxes, CPP pension, and the Canadian TFSA tax-free savings account. So let's get started. Let's start with the CPP pension. You can collect your CPP at age 60, age 65, up to age 70, or any time in between. If you start taking your pension at age 60, the government takes away 0.6% per month for every month that you receive your CPP before the age of 65. If you wait until age 70, the government will give you an extra 0.7% for every month that you wait after the age of 65. There are lots of different discussions about taking your CPP at 60. I read something yesterday that said 1% of all Canadians don't take their CPP at the age of 60, which when you think of that, it means that people want to get that money in their hands as soon as possible. And if you use that money wisely and invest it, then you're going to be farther ahead down the road if you waited until 65 or 70. Because you don't know what's going to happen in life. You can have health problems, you can die, lots of things can happen. So let's use a real world application. In my situation, I had to retire at 60 because of health problems. So I immediately started collecting my CPP. Now, RRSPs were set up many years ago for people to save money for retirement. And the idea was that you would put money into the RRSP when you were in a high tax bracket. And then later on, when you retired and you didn't have as much income, you would start to draw money out of that RRSP. And that makes a lot of sense. Now, there's other ways to do that. Draw down on your RRSP and save lots of tax at the same time. The Canadian government created what they call the TFSA, if anybody is not familiar with that, and it's a tax-free savings account. And it's one of the most amazing things that they ever created. It far outweighs and is better than an RRSP, in my opinion, and here's why. In my situation, because I had to quit work at 60 and start collecting CPP, I don't have a very high income. And when you don't have a high income, that is the best time to draw out money out of your RRSP. Because when you think about tax time, every person in Canada gets a personal exemption of around $12,000. And every year that exemption is going to go up. They figure by the time 2023 comes along, that exemption will be $15,000. So an example is, this year, I took $15,000 out of my RRSP and put it into my TFSA. Now, I did have to pay some withholding tax to remove that money from my RRSP, but at tax time, I will get that money back. So I'm basically taking that money out of my RRSP for nothing, tax-free. Now that it's sitting in my TFSA, invested, it is now gaining income or tax-free money, and it will do that until I'm 65 years old. So if I do this every year from now until when I'm 65, I'll have approximately $75,000 extra dollars in my TFSA by doing this, which adds up to about $52,000. So why is this important? Because when you turn 65 and you start collecting your old age security pension, your income is what decides if you're going to get the extra money from the government. The guaranteed income supplement is based on your income. So if you're getting $10,000 a year, and that's not that hard to get in your TFSA in dividends from a stock, say like Royal Bank, that money doesn't go against your income. It's free, tax-free money. So when I do my taxes, when I'm 65, I will be entitled to the highest payout from the government of the guaranteed income supplement. So what I'm trying to say is from 65 on, I will get minimum $10,000 a year income, completely tax-free. Now this TFSA strategy works the best if you have a low income. And I'm lucky enough that my wife still works at this time, so we don't need to worry about income on my end. So this allows me to have a low income and do the strategy that I've talked about. But this can work for anybody. If one person had to retire early or decided to retire early, and the other person or partner is still gainfully employed. This works excellent in that situation. Now, if somebody is collecting an index pension or any of those situations, then this strategy might not make sense. And I would always advise to make sure that you get advice from a financial planner before you do any strategy. But I wanted people to know about this one because I think that it adds value. And one of the things that I had to do when I had to retire early was figure out the best way to, maximize our income down the road when indeed my wife retires as well. So it makes a big difference in your lifestyle and your ability to do things when you can have tax-free income after the age of 65. You get to take advantage of, the GIS is one example, but you also will take advantage of any other offers that the government has if you're a low-income senior. And this is great because tax-free savings account money is exactly that. It's tax-free. It's invisible. And that can make a big difference in your life. So I hope that this explanation of the TFSA and this strategy can help you in some of your retirement planning. And like I said before, this isn't investment advice or any advice. It's just I wanted to put it out there, the strategy that I'm using, and hopefully you can benefit from it as well. So please subscribe to my channel and hit the like button. Helps out an old guy. I like to know that people are being helped by my videos. And have a great day. Thanks a lot. Bye now.